What's up guys, and welcome back to WSM Research. A couple days ago, we put up a poll asking which stocks we should focus on for our next video. Marijuana stocks Tilray and Aphria won the poll by a pretty wide margin, with 35% of the votes. This is hardly surprising given the recently crazy price action in these stocks and increasing mentions of both stocks on Wall Street bets. In response to the popular demand, we did some due diligence on Tilray and Aphria and we'll be going over it with you guys in this video. Keep in mind that we are not financial advisors and this video is for informational purposes only. In late 2020, Tilray and Aphria announced a plan to a reverse acquisition. This deal is a stock-for-stock combination, which means that one company's shares will turn into the other company's shares on the closing of the deal. In this case, Aphria shares will turn into Tilray shares in the ratio of 0.8381 shares of Tilray for every 1 share of Aphria. Tilray shareholders will see no change in their stock. After the closing of the deal, the holders of Aphria shares will own approximately 62% of the combined company, while holders of the original Tilray shares will own approximately 38% of the combined company. The resulting combined company will have a board of directors consisting of old board members from Tilray and Aphria. It will be the biggest global cannabis company by revenue, bigger for example than Canopy Growth at 874 million Canadian dollars. Additionally, the acquisition will create significant cost synergies in terms of corporate, production, and marketing costs. Management expects that the deal would create over $78 million worth of pre-tax annual cost synergies over the first 2 years. Aside from the efficiency gains to be had from the deal, it also provides an interesting merger arbitrage proposition. Under the terms of the deal, each share of Aphria will turn into 0.8381 shares of Tilray upon closing of the deal. By this metric, each share of Aphria should be equal in value to 0.8381 of the value of each share of Tilray. The strange thing is that is not the case. On market close on February 11th, Tilray shares were trading at about $32.16. So based on the ratio, Aphria shares should be worth $26.95 because the deal specifies that one Aphria share will convert into 0.8381 Tilray shares. But it's not. You could buy a share of Aphria for $21.36 as of the close on February 11th. So here's how one would theoretically take advantage of this arbitrage opportunity. You buy 100 shares of Aphria at $21.36 a share, and sell short 83 shares of Tilray at $32.16 per share. You'll end up getting paid a net credit of $533.28, but now you owe 83 shares of Tilray. When the deal closes, your 100 shares of Aphria will turn into 83.81 shares of Tilray. You then turn around and return those 83 Tilray shares that you owe, and you're left with the $533.28 of credit, plus an extra 0.81 shares of Tilray left over. As long as the deal closes, you've made this $533 profit guaranteed, plus an extra 81% of a share of Tilray, which will be worth at least something. So it's basically free money, hence the name merger arbitrage. The risk, of course, is that the deal doesn't go through. Especially with a controversial industry like weed, it's conceivable that regulators will block the deal, especially if they think it will create a monopoly. If a trader were to try this arbitrage and the deal fails, it's possible to lose a lot of money. It's a very real risk, so make sure you do your own research before entering any trade involving Tilray and Aphria. When investing in any stock, valuation is always something you have to keep in mind. In the case of Aphria and Tilray, they are expensive stocks even after today's pullback of 49% for Tilray and 35% for Aphria. In the trailing 12-month period, Tilray has generated about $200 million in revenue. After today's pullback, their market cap is $4.3 billion. They have a little over $300 million in net debt, giving them an enterprise value of $4.6 billion. This gives them a price-to-sales multiple of 23 times. Aphria has a trailing 12-month revenue of about 600 million Canadian dollars, which is equivalent to 472 million USD. They have an enterprise value roughly equivalent to $5.5 billion, giving them a price-to-sales multiple of 11.6 times. So on this valuation metric, Aphria is slightly cheaper than Tilray. Of course, these standalone valuation metrics are only relevant if the merger does not go through for whatever reason. If the merger does go through, the relative valuation is based on the merger terms of 0.8381 shares of Tilray for each share of Aphria. Even Aphria's price-to-sales multiple is high compared to the broader market, but many investors believe that this premium valuation is justified because of the massive growth opportunity in the cannabis sector brought about by global legalization legislation. Obviously, these stocks will appear expensive at their current financials because they are only just scratching the surface of the long-term opportunity as more and more jurisdictions legalize. Currently, 15 states and the District of Columbia have legalized marijuana for recreational use, and almost all states at least allow medical marijuana or have decriminalized its possession. Recently, the US House of Representatives passed a bill decriminalizing marijuana. The bill is unlikely to pass through the Senate, but is a tremendous signal showing the growing acceptance of marijuana in Washington, D.C. With legalization efforts gaining traction all across the country, we could see some sort of legalization at the national level a lot sooner than people previously thought. If this happens, it could be a major catalyst to push the weed stocks higher. And it's not just the US. Many countries are finally starting to legalize medical marijuana, especially in South America and Europe. As world leaders look at the success of recreational weed legalization in Canada and the US, they are sure to slowly push towards legalization in their own countries. The combined entity of Tilray and Aphria will be a dominant player in the global marijuana industry, both for recreational and medical use. This gives them tremendous opportunity to benefit from legalization tailwinds. While there are certainly long-term tailwinds benefiting the cannabis industry and the cannabis stocks, they are extremely volatile and carry significant risk. For example, Tilray skyrocketed up to $148 at the peak of the weed craze in 2018, before crashing down 97% over the next year and a half. On a fundamental business perspective, while the weed industry is sure to be growing over the next decade, there is no guarantee that Tilray and Aphria can maintain their dominant market position. Marijuana cultivation is an extremely competitive business because just about anyone can set up their own weed farm. So it's very much possible that the big players will lose share to new entrants who also want a piece of the growing industry. The bottom line is that weed is here to stay and there is a lot of money to be made in the long term. But with this year's massive run-up in weed stocks, a lot of this is already priced in, and there are significant competitive risks going forward. And regardless of their fundamentals, these weed stocks have become meme stocks over the past few weeks, and are liable to come crashing down just as fast as they went shooting up. Alright guys, that wraps it up for this video. What do you guys think about Aphria and Tilray? Do you like the long-term prospects of the weed industry? And are there any other weed stocks that you think are better? Let us know in the comments section below. If you like the content, make sure to hit the like and subscribe buttons and follow us on TikTok and Instagram, links in the description below. As always, thank you guys so much for watching, and we'll see you in the next one. WSM Research signing out.